Well, hey there, everyone. Happy Friday, July 25th, and welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from a actually kind of overcast, not quite rainy, but looking like it's threatening to do so, Redmond, Washington. Hope you guys are all doing well. I know it's a bit of a heat wave in the Northeast region of the United States. So those of you in the New York, Boston kind of areas, I wish you cooler days ahead for sure, but I hope you're weathering things all right. Speaking of weathering things all right, the market continuing to push higher. We're recording this a little earlier in the afternoon, about an hour before the U.S. market close here on Friday the 25th, but looks like the S&P will have another strong day and really one of the stronger weeks we've observed off of the April low. So while we can tell you all sorts of potential headwinds for the market, while I can highlight things that could cause the market to go lower, I always remind you, and I hope this is what you get out of watching this show regularly. I see there is a big difference between the macro themes and things we think could impact the market and what could happen, which is real conjecture more than anything, versus the reality of what the markets are doing and just analyzing the trends. I feel like as investors, we spend way too much of our time trying to predict the future or feeling that we have the ability to do so with any sort of accuracy, and underserving or underappreciating the value of just keeping your eyes and your ears open and recognizing what is happening. What I've learned over my career is charting and technical analysis is so valuable in risk management, because one of the biggest mistakes people have is selling too late, right? Having a position that works and then the position starts to roll over and you're holding it that whole way up and feeling great. And then you keep holding it as it goes down. And so it's less about predicting when that peak is going to be and more just like, waking up and recognizing, okay, this position is no longer deserving a place in my portfolio. That is what we try to focus on. It's trend following. It's confirming when trends are shifting. We'll talk about what could happen. We'll talk about potential narratives. We'll talk about potential impacts, because that's the best we can do, right? Is just think based on our understanding of market history, what could happen, but none of us knows the future. Even though I'm sure some with YouTube channels and a megaphone will do their best to tell you they can't tell the future. No one can, but we'll do our best to keep you on the right side of things. So what we like to do on Friday, do a brief market recap. We'll take a look at the major averages here, and recording this just after 3 p.m. Eastern. So we'll look at some of the movements today, and then we'll get into some of the great questions I've received from viewers like you this week on the show. As a reminder, anytime we're doing a live stream, anytime you're watching the replay on our YouTube channel, please share your questions as they come into your brain. Pop them in the comments section wherever you're seeing the show. I gather every one of those. I look at every single one of them, and then I hand select some great questions to dig into a little more detail in answering on a Friday mailbag show. So some great questions to highlight for all of you. But first, let's just talk about this resilient market environment. Again, last hour of trading has been a tough period, right? And in recent days, we've actually seen some sell-offs in the last hour, but overall, the trend has been positive. So at this point, the S&P is sitting just below 6,400. We have never had a close above 6,400. I don't know if that's going to happen today or this week, but overall, certainly the market's finishing the week in a position of strength. All the major averages are moving higher. The VIX is getting very close to a 14 handle, meaning below 15, which is pretty rare, to be honest with you. Before we get too excited about, okay, that's an obvious sell signal when the VIX gets very low. It actually is not a great sell signal, because in protracted inclines, right, and when the market is in a consistent low volatility uptrend, the VIX can get low and stay low. And we've seen the VIX remain in low to mid-teens for extended periods of time. So I've not found that to be a particularly great sell signal of any sort. Just reconfirms or reaffirms the fact that the market is in a pretty consistent uptrend. Rates are continuing to drift lower here. We have stocks and bonds moving higher today. And so rates are continuing to drop. The 10-year point is now below 4.4%. The long bond getting close to 4.9%. 5-year point around 3.95. So we're seeing rates drift lower, potentially in anticipation of the Fed lowering rates here at the next couple meetings. Potentially, the dollar not too much of a change. Commodities generally lower, although natural gas prices look to be moving higher today. Gold prices, silver copper, crude oil, all in the red today. Cryptocurrencies going a bit risk off here. They actually rolled over in the last 36 hours or so, going from around almost 120 down to almost 115. Currently just above 116,600 on Bitcoin, and Ether prices just above 3650. Looking at the sectors, you can see for now, again, we've got an hour left in the session here on Friday, but top sectors are materials, consumer discretionary, and industrials. So again, technology kind of middle of the road here. We've talked through the course of this week about leadership rotation, about other sectors starting to emerge in positions of strength. So we've seen a little bit more of that here today. Keep in mind, however, next week, a big earnings week. This week was pretty heavy with earnings. We had Tesla and Alphabet. Next week, 4 of the Magnificent 7 stocks reporting. You've got Microsoft and Meta both on Wednesday. On Thursday, we have Apple and Amazon on the last trading day of July 2025. On top of that, a bunch of other S&P 500 names reporting. Too many to refer to here in today's episode, but I would encourage you to find an earnings calendar and keep a close eye on it. I keep an eye on the earnings calendar on stock charts. You can find that here in charts and tools. Oh man, they consolidated these. Where is it? Oh, I think you have to go to all tools now. They just changed this week here. Yeah, where is it? Oh, you go here. Yeah, I'm not sure where it is. It's in here somewhere now. Earnings calendar. It's on here. Scans and alerts. Market analysis. There it is. First try. Found it. Sorry about that. They just changed it. I haven't had a chance to look at this. Grayson even told me this was coming. I saw him in the stock chart studio and he was like, hey, heads up, we're making a big change to the menu. And I was like, oh, cool. And then I totally forgot to actually look at what had happened. So there you go. It's just consolidated. It was pretty unwieldy before, so it's probably a nice improvement. You can find it here in our market analysis with the earnings calendar. I actually use the earnings calendar on Koyfin quite often, which is a product that I use all the time. This is Koyfin's earnings calendar. I'm just looking at the NASDAQ 100 because I wanted to quickly find which of the Mag 7 names are reporting. Deep economic data, fundamental data, scanning tools with non-technical inputs as well. So I found it, and also ETF holdings, which is what I use the most. So pretty helpful for that as well. All right, what else can I tell you about the markets here on Friday, July 25th? The breadth kind of mixed today, kind of not great, not bad, although the S&P breadth more positive than negative, about a 2-to-1 ratio of up versus down. Less ideal for the NASDAQ, less ideal for the New York Composite Index. Mag 7 names overall pretty good here. Tesla bouncing, although it was down a ton yesterday, so let's not get too excited about a 3% rally. That's after yesterday's big gap down after a earnings that sort of implied some cautionary guidance looking forward. Microsoft up 1.2% going into earnings next week. Amazon, the only name at this point, although Apple is flat, and Netflix not particularly strong going into the weekend here. Last things I will show you just here at the bottom, right? Here's our daily chart of the S&P 500. And as I mentioned, right, I mean, the essence of trend following is to not spend as much time worrying about pinpointing the top. I mean, as an investing community, I feel like we idolize people who claim to have pinpointed peaks and valleys as if that is really the game. And I would argue it is not. The game should be recognizing shifts in trends, right? That is the mistake investors make. It's not, having a perfect hindsight and knowing it, a crystal ball and knowing what's going to come next. It's just waking up and realizing that the picture has changed, because so often we hold on to what worked in like the last cycle, and then we ignore when the evidence has shifted. The evidence has not shifted yet. The trend is positive. The S&P has a healthy lead, about 150 points above its 21-day exponential moving average. I'm not concerned until that starts to break. All right, shall we get to some questions? And again, these are questions that have come from people like you over the last week. Please keep the questions coming. Makes the show entertaining for me. I hope it gives you some interesting insights to think through, and hopefully some nuggets of investment wisdom. Here's question number 1. I noticed that the relative strength, this is when we're looking at Williams WMB. So looking at the relative strength of Williams versus the S&P had gone down since mid-April. Does that mean I would have been better off in SPY than WMB over this time period? And does stock charts adjust this ratio for dividends? It's a multi-bagger question, so let's get to it. I don't remember the exact chart I was showing when we looked at Williams, but here is a, we'll say a 1-year chart of Williams. I mean, it's sort of stalled out here, right? And sort of made a new high, but kind of coming down a little bit. And your question is, the relative strength has been going down since mid-April, right? So think about it, right? Williams from mid-April to now mid-July had that initial rally, and that's it, right? We're kind of right where we were at that point, while the S&P and the NASDAQ have been going to new all-time highs. So that's why Williams is underperforming, because it's flat while the markets have been going higher. So this ratio of Williams versus the S&P has been going down. So does that mean you would have been better off in the SPY than Williams? For sure. That is absolutely what that means, because, and that's what the line going up means Williams, or whatever stock or ETF you have, has been outperforming. So if you look at like the 6 months prior, Williams was much better because the S&P was selling off and Williams was basically holding its ground. But then Williams remains holding its ground while the S&P is lighting up to the upside. And so the relative performance is down. So it is definitely saying you would have been better off holding the S&P versus Williams and pipeline companies like that. Does stock charts adjust this ratio for dividends? So that depends. Its default is to do so. So when you bring up a stock on the stock charts platform, you just bring up a ticker, it's using what's called adjusted data. And you can see that is checked off below the chart, and it defaults to being checked off. What that means is anytime a company like Williams, which pays a decent dividend, 3.5% dividend yield for the 12-month period. So when a stock pays a dividend, basically the price of the stock goes down for the amount that is paid out in the form of a dividend. So basically, as a shareholder, you remain whole because they're taking some of your stock value away, but paying that out in cash or in the form of a cash dividend, right? So, and that's a normal quarterly process for a lot of companies, not all companies, but a lot obviously pay a dividend. Excuse me. And so that is, sort of a well documented structure in equities. So what happened, what do you do with the historical data? So there's two ways you can think of it. And chartists, at technical analysis conferences, we argue about this over cocktails, is basically, should you adjust for dividends or not? Because what one way of thinking is you should never adjust the chart. Why would you adjust the chart? The price is the price. So you just bring the price down. When they pay a dividend, you just, jump down and you keep charting the price. The problem with that is two things. Number one, it creates these gaps on the chart that are just structural changes. It doesn't really imply any change in, investor sentiment. It's just a capital change in the structure of the stock. And all your indicators are going to be skewed by that, right? So when the company pays a dividend, the price gaps down, the RSI is going to gap down because it's calculated off of those prices. So John Murphy, who is a famous technical analyst who really, his approach is what defines the stock charts, general way of doing things, at least the default way of doing things. John's approach was you should always adjust historical prices for dividends, because then when you're analyzing prices, you're analyzing investor behavior and not getting that skewed by some, random dividend that might be paid. And as a result, all of your indicators are going to be reflective of that, investor behavior. And that's really what we should be measuring anyways. Now, other technical analysts may disagree. And that's, again, why we argue about things sometimes. So having said that, the default is to adjust the data, which means your relative strength is good to use this way because it's showing you the total return of Williams versus the total return of the S&P. If you would take that adjustment off, now you are not including the dividends in the relative performance, something to keep in mind. Really only impacts things if you have a company that pays a decent dividend. With Williams, it actually is. So if I'm analyzing pure price action, I might go with the unadjusted data so I can focus on support and resistance levels. If I'm analyzing relative performance, though, I will always use the adjusted data because that's a better measure of the performance of the stock versus a benchmark. Great question there, and a long-winded answer. I'll try to be a little briefer here. Why not use IJR for small caps? I get this question, some form of this question, a number of times. So there are a lot of indexes and ETFs out there to use. Is there a right answer? I don't think so. There's just a lot of different ways to think about it. One thing I will tell you is the S&P 500, by far the most commonly referred to index or benchmark in the US. So that is definitely the one I would use. And again, probably part of this answer is skewed by the fact that I've spent a lot of years working for institutional money managers, and your job was to beat a benchmark. So we focused a lot on what benchmark we were using, which meant if you were a, kind of classic S&P 500 manager, you would use the SPY. If you were running a small cap value fund, we would use the Russell 2000 Value Index or whatever benchmark was assigned for that portfolio. And at Fidelity, when I was there, we just used the Russell 2000 as the benchmark for most small cap things. We didn't really use the S&P 600. So Standard & Poor's, right? The S&P, Standard & Poor's, like the S&P 500, their indexes are the S&P 500 for large caps, S&P 400 for mid caps, S&P 600 for small caps, and then they have an S&P 1500 index, which combines all three of those. And that list of 1,500 stocks is a pretty good working list of like the stocks listed in the US that you should probably be aware of. So in the scanning engine, I love to do scans where I look at, is it a member of the S&P 500 or 400 or 600? I know that's a pretty good list of liquid stocks across different cap tiers. And then the S&P 100 is a subset of the S&P 500. It's actually included in that 500. Now, the Russell people, the Frank Russell people, have their own benchmarks. They have the Russell 1000, which is a big large cap benchmark. And then they have the Russell 2000, which is their small cap benchmark. And they have the Russell 3000, which combines all of those names together. There's no perfect answer. Bloomberg has their own indexes. FactSet had their own indexes. Everyone has their own indexes, and all, index providers and exchanges are all trying to make money with their own infrastructure of index classifications and how it works. The most commonly used ones in the US are the S&P 500 sectors and classifications. But for small caps, the Russell 2000 is just used more often, and that's why I use it. For the most part, they are often interchangeable. The IJR, which is an S&P 600 small cap ETF, and the IWM, which is the Russell 2000 ETF. So I actually sometimes will switch randomly, and that's just to give them both some airtime, I guess. I heard another analyst say that ETFs, especially index funds, are a legitimate bargain when the price drops below the 200-day moving average. Do you agree? Ooh, so hard to evaluate someone else's comment taken out of context. I'm basing it on what you just asked me. I don't know exactly who this is or what they were talking about. Would I agree with that? I mean, maybe, right? And I would say as a technical analyst, it's hard to generalize like that. And that's why I don't like to generalize. I mean, Paul Tudor Jones said nothing good happens below the 200 day. That is a huge generalization that literally nothing, you should never touch anything below the 200 day. There are times when a chart looks kind of interesting. It's had a big sell-off and it starts to show signs of accumulation. I probably would take a position before it reached the 200-day moving average. I could make that argument. So I struggle a little bit to generalize that much. Now, what I think they're getting to, I'm guessing, again, taking this out of context, I'm guessing one thing they're getting to is if you look back through market history, generally things spend more time above their 200-day moving average than below them, generally, because generally markets have been in an uptrend over many, many, many years. So, when we go below the 200-day, one thing that is almost certain is that eventually we're going to get back above the 200-day. At least market history has been, has basically followed through on that guarantee 100% of the time, right? Anytime we've broken below the 200-day for the S&P 500, we've eventually gone back above it. It makes me think of the interview I did with Bob Pisani. We just released that earlier this morning. What a fun interview. That was a cool one. It was great asking Bob about a lot of cool anecdotes from the New York Stock Exchange floor and stuff like that. He had some strong opinions about a lot of things that it was really helpful to kind of, pick through with him. But one thing we talked about is that major corrections over time always present great buying opportunities, right? When a market gets below the 200-day moving average, two things I will tell you is that at some point it's going to go back above the 200-day moving average, and at some point it's going to be a really good opportunity to buy in at a deep discount. And so that I think is maybe what they were speaking to, is that things don't stay below their 200-day moving average forever. At least most things don't, and generally the market tends to recover. So betting against the market can be a profitable strategy in very limited timeframes and very limited instances. but you're much better off as an investor assuming that the market's going to recover and go higher, because that's what it's always done. So I don't know if I would, I mean, so for me as a technical analyst using charts and tools for timing, things breaking below their 200-day moving average are not when I would generally start buying stuff. So I would disagree with that blanket statement that they're a bargain when the price drops below. When something is below its 200-day moving average, does that mean eventually it will be a fantastic bargain and a great buying opportunity? Absolutely, I would agree with that assessment. So I'd probably tweak the nuance of that quote, but if that's what they're getting to, I would say, yeah, when things go below the 200-day, I always say you look for signs of accumulation. You look for signs that the thing deserves to be in your portfolio. That's what I would be looking for. By the way, if you want to learn more about some of the tools and techniques we talk about on Chart This with Dave Keller, number of different things you can do. Of course, on my YouTube channel, I've got a lot of great videos just talking about different tools and techniques and things that I've used, scans that I run, and all of that. I try to share as much as is reasonable to do. I also have some great books on my website that I'd be happy to recommend to you. You can go to marketmisbehavior.com/reading list, or just go to that website and you'll see a link for the reading list at the top. You can also scan the QR code that you see on your screen. Number of books that I have on there that I've read, that I've hand selected, and that I would say are a great set of additions to your library, from technical analysis tools and concepts to behavioral investing and behavioral biases to momentum investing, general investing, words of wisdom, and lots more. So check out the recommended reading list at marketmisbehavior.com. Check it out. It's awesome. Next question, semiconductor ETF. It's a very important subsector. I would wholeheartedly agree. How can we have breadth for SMH? Like, I see what you're saying. So, right. So to summarize your question, you're basically saying we have breadth indicators for different things. How come we can't get breadth indicators for semiconductors? So one of the charts that I show often is like this one, right? Stocks above their 50-day, stocks above their 200-day. These are the tickers. And you're saying, how come we can't do the same thing, but for semiconductors? Great question. Honestly, it probably wouldn't be as helpful as you think it would be. The benefit about doing it on the S&P 500 index is that it's a pretty diverse group of stocks, particularly when you look at an equal weighted analysis, right? So if I'm looking at all 500 names, there are stocks that are going up and probably stocks that are going down, and looking at the movement of stocks across sectors is the benefit of this quarter breadth indicator. When you do breadth on a very narrow and fairly homogeneous list of stocks, I don't know if it's going to add a ton to you. I mean, right now you have like Intel not looking particularly good. You have Nvidia looking very great, and you have other stocks in the middle. So maybe there would be something there. But generally, kind of most of the semiconductors besides Intel generally kind of move in similar ways, I would say. So the short answer is no, I've not seen breadth on groups like that. What I would tell you is breadth indicators tend to be more helpful when it's a broad universe, and then the breadth makes sense, right? The breadth has value because it's helping you understand a little bit more about all the different stocks and what they might be doing. I would question how helpful that's probably going to be. That's one of those that feels like you should need it. I don't know how helpful it's going to be, but a fair question. Something I'll raise with the good guys and women at Stock Charts. Maybe they can work that out for us someday. Next question. How about the tax consequences of rotating into things that are going higher and out of things that are no longer leading? I often worry about the tax consequences of short-term gains. So there's a disclaimer that whether you read it or ignore it every time I do content, I have a disclaimer somewhere in the description, often on the screen at the end of the episode. I actually flash this disclaimer, which is, basically says this is all for educational purposes. These are not recommendations. And I take that very seriously. I mean, that part of what I do as a professional, as a content creator, part of what I feel I sign off on with the ethical standards we have at the CMT Association, which is where I'm a chartered member, is that, we agree to uphold ethical standards, which means we, one of those things I think that means is that you fulfill your fiduciary role appropriately. And for me, I have a very clear mandate, I feel, which is to educate and to empower investors to make better decisions. My goal is not to recommend things, and nothing that I show you is me either covertly or overtly telling you, go buy this, go sell this. That's not my place. And I think that's important important to stress, because the reason why that's not helpful for me to just say you should go buy something, which I will not do, is because there are things that that you are in your own portfolio. There are questions that only you can answer, or that you can answer with a financial professional who is looking with you at your own personal situation. Things like tax implications, I have no place to be telling you what to do in terms of tax benefited, tax short-term gains, and how to be thinking about that tax loss harvesting. These are all techniques that financial professionals would use. Depending on your situation, it's something you should definitely be looking into. It's something I use. I absolutely, at the end of the year, start looking at short-term gains, long-term gains, what sort of trades would impact my tax, burden, or my tax, like taxable income for the year. So these are things I absolutely think of, and I would encourage you to, to either learn more about the tax advantage strategies, which is basically thinking about trading not just from the trading perspective, but also the fact that there's a money management side. And for me, I would think of tax implications or tax consequences as part of the overall, like when you actually go to pull the trigger, what are the things you should be thinking about? And I think of it as a total due diligence, right? The cost, right? The cost, actually, the commission, or the cost of actually making the transaction, and what that implication is. The spread, right, in something, and how wide or narrow the buy sell spread is, right? So where you can reasonably get filled, the liquidity, and how easy it's going to be to make your buy and sell order actually be filled when you want it to get filled at the appropriate levels. Management fees for ETFs, risks in ETFs like liquidity risk and volatility risk, tax implication. I think those are all part of the things that I'm not really equipped to talk to you about in the course of this show. My goal is to give you the tools and techniques you need to understand the charts, to think about entry and exit points, to think about how you may want to be reallocating. But then I think the steps you want to take after you review this information is to think about all these other parts of it, which I would consider part of the money management process. So there are great resources, and certainly lots of financial professionals who are registered and able to talk to you about tax implications. I would encourage you to, have conversations with someone who has the appropriate designations and registrations to be able to, have an informed discussion with you about tax consequences. I know that's something I review with my accountant every year. It's something I review in my own accounts at Fidelity and elsewhere. And I would encourage you to do the same. So outside the scope of what we talk about, that is one of the many reasons why I don't ever say I recommend you buy or sell this stock at this level, because that would imply that I have knowledge of, just that I'm either ignoring, or that I know how that's going to benefit or hurt your tax, situation and your portfolio. And that is not something I think either of us probably want. That's why I would avoid it. So I would say, yes, absolutely. Part of the thought process you should be having as an investor. And either I would encourage you to research that and or consult with a financial professional who can give you all the details you need. Final question, then we'll call it a weekend. How much do you feel the dominance of mega cap growth stocks has been driven by retail investors chasing what is new and what is popular? Do retail investors have more power now? I'm summarizing a fantastic question that I received through the YouTube channel this week. I love it. And again, my interview, I got this before I interviewed Bob Pisani, and I was able to get the conversation to kind of go here because, it hit me that Bob started in the industry in 1990, or at least his first job at CNBC was as a real estate reporter in 1990. He moved to the floor of the New York Stock Exchange late 90s, and then almost 30 years on the floor of the exchange. That's where many of us have come to know Bob and his work. But we talked a lot about how the industry has changed, how the environment for investors has evolved. What trading was like in the late 90s versus what it's like in the mid 2020s. And I didn't mention this in the episode, but my first trading account was a Daytech Online account. I was at Bloomberg at the time, so I was watching Bloomberg television. I was using the Bloomberg terminal that I had access to, and I was trading on my Daytech Online account all at the same time. And I was having a blast. I was loving it. But you certainly had this feeling that there was a huge influx of new retail traders drawn to the .com era, drawn to Pets.com and all the other internet names that had just absolutely erupted to the upside in the late 90s. And my introduction to trading was just watching those glory days of the late 90s get absolutely bubble bursting in my face as things started to look a lot less fun. And I learned a lot about risk management. I learned a lot of painful lessons, luckily with a very small trading account at the time, about what not to do. And those formative years I'm now so thankful for, even though it was rough at times. And what Bob and I talked about, and I'd encourage you to listen to the interview on our YouTube channel and on all the podcasting platforms. We talked about how retail investors really have become more dominant. And in the late 90s, that's one of the many things that fueled CNBC to become almost like a cultural, a thing that most people kind of knew, and gave an opportunity for Bob and Jim Cramer and others to become more household names because it was something people were excited about and people were actually trading in their homes. And stock charts, by the way, was started in the mid 90s, right? As part of that wave as well. Fast forward to like the 2020s, and you can see the same kind of reemergence of a new cohort of very passionate retail investors. The Robinhood crowd starting to trade during COVID, the crypto crowd trading this new asset class, making a lot of mistakes, a lot of fear, a lot of anxiety, a lot of volatility in the markets as a result of that. So absolutely the picture has changed. And I would say retail investors now more empowered than ever. We saw that with the whole GameStop saga and other names where they could literally, drive movements and affect the returns of institutional investors. Now, how much of the dominance of mega cap growth stocks have been driven that? I would say I don't think as much by that. I mean, partly, right? I mean, I think in the end, investors often Peter Lynch style kind of invest in what you know, and also invest in the latest fad, the latest thing, the next big thing. The next big thing has been AI, and the best AI plays have been the big mega cap growth names like Meta and Alphabet and Microsoft and others, and NVIDIA and chip makers. So it's not surprising that those are the stocks that have been dominant, and that's where so many people are focusing their attention and indeed their capital. I would also say for institutional investors, there's been an absolute need to capitalize and to participate in the uptrend in AI. So the big moves that you see in those big stocks are also driven, I would say, by institutional investors that feel that they have to have exposure to these themes that are doing so well. This altogether makes me think that at some point that market, that optimism, that euphoria becomes overextended, and all of a sudden we've gone way higher than we probably should. And even if the growth in AI and the dominance of AI is a thing we'll be dealing with for many, many moons, it doesn't necessarily mean we can't have some big swings between here and there. So those are some thoughts on that. I definitely think the impact of the retail investor greater now than ever. I would say institutional investors still run a lot of capital with a lot of zeros with big funds and big accounts. And I would say their influence is part of it too. And paying attention to flows as represented by the flickering ticks that we talk about on the show every day, probably more important now than ever. Folks, that was fun. Some really cool questions, some thought-provoking questions, some charty questions, and everything in between. I hope you enjoyed the discussion. Hope this made you think, gave you some ideas about things to reflect on over the weekend. And I hope that you tune back in next week and in future weeks as we navigate these markets. The seasonality going into August and September is going to rotate from seasonal strength in June and July to seasonal weakness in August and September. We'll be here along with you, tracking the market movements, looking for signs to be concerned about, looking for trend reversals. So please keep tuning in, and we'll look forward to charting the course along with you, pun very much intended. For Market Misbehavior, I'm Dave Keller. Have a fantastic weekend. And remember, it's always a good time to own good charts. Take care, folks.